The Tory Heartlands debt crisis presenting a major headache for Sunex. Standing on a solar farm in Swindon, Liam Kavanagh had a business proposition for struggling local councils desperate for cash. Among them was the Tory-led local authority Thurrock, which agreed with the financier to purchase a solar farm in Swindon through bonds marketed by his company, Rockfire Capital, in exchange for millions of pounds in interest payments. Following the agreement in 2016, Thurrock agreed to buy another 52 solar farms through Kavanagh's enterprise, investing £655 million of public cash borrowed from other councils. Kavanagh, who denies wrongdoing, subsequently purchased a private jet, a yacht and a country estate. But by the end of 2022, Thurrock had effectively declared bankruptcy after debt ballooned to £1.3 billion and losses on the project totaled £200 million. It is one of many local authorities that have been left drowning in debt after a pre-pandemic borrowing spree and that now threaten to be a thorn in Rishi Sunak's side in the run-up to the election. 8 councils have issued Section 114 notices since the end of 2020, meaning they are effectively bankrupt. Far more are on the edge, and many of those with the biggest debt bills are concentrated in Tory heartlands. Local government finances are in a well-documented funding crisis, and the issue is a ticking time bomb for any new government. An internal dossier of impending problems drawn up by Labour's Chief of Staff Sue Gray warns that bankrupt councils could ruin the party's honeymoon period if it comes into power. But that same problem might also help Labour win the election. Councils are grappling with the toll of long-term funding cuts, just as they are facing soaring demand for services such as social care. In the wake of austerity, many also took on large debts to invest in new sources of income such as offices and shopping centers. Since then, interest rates have soared, commercial property values have slumped, and councils have been left scrambling to pick up the pieces. According to analysis by the National Institute for Economic and Social Research, local authorities have lost £80 billion in net worth since the end of 2021. Across England, councils are now spending on average 15% of their budgets on debt servicing costs. In 23 local authorities, councils are spending more than 40% of their annual budget on debt interest. In Spelthorne and Runnymede in Surrey, the council's debt interest bills are 303% and 181% of their respective core budgets. Of the top 10 councils with the largest debt interest bills in proportion to their core budgets, 9 were in the south of England, according to NICER. 7 were in Tory constituencies, and 5 either had Tory councils, or did until the vote swung to Labour at the local elections in May. Councils' cash problems began with austerity. Back in 2010-11, councils' core funding from central government was £71.8 billion, based on today's prices, according to the Institute for Government. By 2017-18, this had plunged by more than £16 billion. This figure has climbed since, and after a funding uplift announced in January totaled £64.7 billion. But this is still down by a tenth, compared to 14 years earlier. In a clear mirror image, as central government funding dropped, local authority borrowing rose. Between 2013-14 and 2020-21, local authority borrowing rocketed by 26%, rising from £78 billion to £98 billion, according to IFG analysis based on today's prices. By 2022-23, the total had dipped to £94 billion, but this was still £16 billion higher than in 2013-14. Local authorities were piling into commercial property investments, buying offices and shopping centers in an attempt to find new sources of income. The story we got from councils was very much, "We need an income stream because the government has essentially taken away our income stream," says Matt Oakley, head of commercial research at Savills. Interest rate cuts following the financial crisis meant borrowing costs were at historic lows and councils could get debt at even more favorable rates from the Public Works Loan Board. Oakley adds, 2016 to 2019 was the boom period. Although councils made up a small proportion of the market at their peak, councils made up 3.5% of commercial property deal turnover. They sometimes led market pricing because favorable PWLB rates meant they could bid more aggressively, says Oakley. They are punting like drunken sailors all around the country, one fund manager, who had been outbid by several local authorities, told the Financial Times in 2017. Matthew Oakeshott, chairman of OLIM Property, says, "The wide boys in property couldn't believe their luck. They saw the councils coming from a mile off and unloaded the stuff they couldn't shift anywhere else. Some council investments were particularly ill-advised, such as those by Nottingham and Woking councils, which have both since issued Section 114 notices. But many did bear fruit. Spelthorne, Runnymede and Stevenage, which are among the councils with the biggest debt bills, have been earning more on their property income and other commercial income than they have been paying in debt interest. And unlike many other councils, they have been able to pay into their reserves, says David Phillips, of the Institute for Fiscal Studies. Yet high levels of debt come with big risks, particularly when interest rates have climbed to a 16-year high and commercial property values have plunged since the pandemic. Now the big question is, when do local authorities have to renew their debt, according to Max Mosley, senior economist at NISR. If they have to renew that debt in the short term, when interest rates have gone up very, very quickly, this may not have been factored into the business model, he says. Timing is also crucial, Oakley adds. Much of what councils invested in were offices, which have plunged in value in the wake of the pandemic shift to home working. We now have a situation where local authorities have got assets that have been marked down by 40% or 50%, and maybe the income has fallen away, says Oakley. This is happening at the same time that councils are grappling with balance sheet pressure across the board, he adds. All of their wage bills have gone up. All of their fuel bills have gone up. They are under pressure to find capital very quickly, and the knee-jerk reaction is to sell these assets. This is a really bad time to sell. It is the worst time in the commercial property cycle to be forced to sell an asset because they will get the lowest price, says Oakley. Councils in the south of England are more exposed to debt interest and swings in the commercial property market because of a quirk of how UK local authorities are structured, says the IFS's Phillips. Almost all of the top 50 councils with the biggest debt interest bills relative to their core income are shire districts, he adds. Shire districts are responsible for street cleaning, local housing services, refuse collection and local economic development, but not big-ticket services such as social care and public health, which are covered by county councils. If they borrow for development, it is a much bigger share of their budget, says Phillips. Shire districts are heavily concentrated in the South and Midlands, whereas the North is almost exclusively governed by single unitary authorities. Teetering council finances will be a key challenge for Tory MPs campaigning for re-election in the South this summer. Problems with local government will be a headache for the Tories because councils are often responsible for many voters' everyday impressions of the state. You can't hide potholes, says Tony Travers, visiting professor at the London School of Economics Department of Government. They are a very unusual manifestation of lack of public resources at the most local level. Potholes and dim streetlights go to the core of why we have government at all. Please like, share, and subscribe to our YouTube channel for getting latest update of United States, trending news and top stories about USA.